We just got some data showing that the United States economy isn't growing as fast as a lot of people thought. Take a look. The US economy grew by just 1.6% in the first quarter of 2024, much slower than expected. Now, I know a lot of people and news agencies have been covering the slower than expected economic report, but I want to go a little bit deeper and talk about two things that you really want to understand. Number one is that while we got the slower than expected economic growth, inflation also came in hotter than expected. And second is, well, the White House's response to the slower than expected economic report. Let me just read you the first line from Reuters. U.S. Treasury Secretary Janet Yellen told Reuters that the United States economic growth was likely stronger than suggested by the weaker than expected data on the first quarter output. Data schmata. Who needs data anyways? So what I want to do today is go over four things. Number one is I want to go over what the economic report said, that we get a better understanding of what's going on with the economy. Number two is I want to talk about this relation between the economy, inflation, and interest rates, especially given this new economic report. Number three, I want to talk about the White House's response to this economic report, not in a political manner because this is not a political channel. Just want you to understand what's going on. And number four is I want you to understand and find the opportunity because, well, everything creates opportunity if you know where to look. So let me start by talking about number one, what actually came out in this economic report. Now, if you're subscribed to Market Briefs, you already know this, but let's dig a little deeper. This is a chart showing quarter over quarter economic growth, and what you'll see is that in the first quarter of 2024, our economy grew by 1.6% when it was expected to grow by 2.5%. Now, if you read any of the traditional media reports on this, there's a lot of reasons as to why the economic numbers came out slower than expected. Some people say that it's because we took on more imports than expected. Some people say that it's because businesses are carrying more inventory. But I like to look at this more from a very basic and practical level. And the way that I like to look at it is just by looking at how the economy works. Because at the end of the day, our economy runs on spending. If you spend money at Chipotle, Chipotle makes more money, and that's good for the economy. If you don't have money to spend at Chipotle, then Chipotle doesn't make money, and that slows down the economy. And so in this economic system that runs on spending, the more people spend, the more the economy grows. And what we've been seeing happen is just naturally people have been having to make more selective spending decisions. Now, part of the reason for this is because we've seen all this high inflation from 2020 until now. And because of that, people have less discretionary spending, meaning Americans are essentially running out of money because people have to pay more money for their housing, they have to pay more money for their car, they have to pay more money for the groceries, which means they have less money left over to do other things. Now, normally, when you would think if somebody has to spend more money on their house, their car, and their groceries, they might have to downsize on other things. But what we've seen happen, especially over the last couple of years, is that Americans have been looking for creative ways to continue maintaining their lifestyles, even if their incomes are not keeping up with the higher cost of living. Now, how are people doing that? Well, first, it was credit card debt. Then it was buy now, pay later. And now we're seeing a record number of Americans dig into their retirement accounts through a 401k hardship withdrawal. That way they can pull money out and continue maintaining their lifestyles. Now, of course, these things are just not sustainable. And so if people can't keep sustaining the same level of spending as before, eventually people have to cut back on spending. Now, is that what's happening right now? We don't know. This is just, again, a theory. But what we know is that when people max out their credit cards, when people can't dig into their savings anymore, when people can't dig into their retirements anymore, they will eventually have to cut back on spending. And we know that there is a breaking point. We don't know if we're there or not, but that's something that you do want to pay attention to. Now, of course, Market Briefs is my free financial newsletter where my team at Briefs Media publishes this newsletter every day to keep you updated on what's happening in things like the economy, the housing market, the stock market, crypto, and the global economy. It's a fun, witty, and easy to read email. You can read it in less than 5 minutes every morning, and it's completely free. So if you haven't joined Market Briefs yet, I got the link to how you can join down in the description below, or you can go to briefs.co/market. That's briefs.co/market. Now, the second point here that you really want to pay attention to is inflation, especially when you compare it to the economic growth. Take a look. The core inflation, the core personal consumption expenditures index, grew by 3.7% in the first quarter of 2024, above the estimates of 3.4%. This is where you can start to see the issue because on one hand, we have the economy growing by 1.6% based off of the most recent data. But inflation at the same time was coming in at around 3.7%. Now, the reason why this is so concerning is because if we take a look at wages, what you'll see is that wage growth has been shrinking. And so now, when you take a look at all these three things together, you have an economy that is cooling, You have inflation that over the last few months has been heating upwards while wages are going downwards. So things are getting more expensive, incomes are not growing as fast as they were before, and our economy is also cooling down. Now, the reason why this is so significant is because a lot of people have been worried about this worst case scenario called stagflation. And what stagflation is when you see rising prices, higher inflation, with a cooling economy and higher unemployment. Now, we're not seeing this higher unemployment yet. But if the economy continues to stay cooler, and if it continues to cool, because we don't know what's going to happen 6 months from now, 12 months from now, 18 months from now. We're going to have to wait to see what happens then. But if the economy were to continue cooling and inflation stays stubborn or continues to go higher, that would be a big problem, because that would mean that people would be losing their jobs in a cooler economy, because that's what happens as the economy cools. People tend to lose their jobs. And if people are losing their jobs while wage growth is slowing and the prices of things are still rising quickly, that puts more financial pressure on people, because that means groceries keep getting more expensive, but wages are either staying the same or they're shrinking. And that's at a time where the prices of things are already so much more expensive than they were just a few years ago. And this is where now it's putting more pressure on the Federal Reserve Bank on what they should do when it comes to interest rates, because the Federal Reserve Bank has been working to raise interest rates in order to cool down inflation. But there's been a lot of confusion because everyone was expecting interest rate cuts early in 2024. Yet here we are now in April 2024, and everybody keeps pushing back their expectations for when interest rate cuts are going to happen, because inflation keeps coming in hotter and hotter and hotter. The last 3 months, we've seen inflation go up, not down. Because of that, the Federal Reserve Bank has essentially pushed back their target to start cutting interest rates. Now, part of this balance or dance act that the Federal Reserve Bank is doing is, on one hand, they want to cool down inflation, but on the other hand, they don't want to break the economy. Now, we are nowhere near a broken economy today. I mean, a 1.6% economic growth is still economic growth. That's not a broken economy by any means. But if we continue to see a slowing economy and the economy starts to shrink, that would be very worrisome. And you have to also understand that the Federal Reserve Bank, although they're not federal, it says so on their website, there is pressure on them. Now, the Federal Reserve Bank says that they're not influenced by politics and the government, but sometimes what people say isn't always what happens. So this is where now there's a lot of uncertainty as to what the Federal Reserve Bank is going to do. Because if the Federal Reserve Bank were to cut interest rates, well, that could boost up the economy. Because if they cut interest rates, what's going to happen? People are going to buy more cars. People will buy more homes. I mean, that's what happens when interest rates go down. But the downfall to that is that would also make the inflation problem worse. Because if people start going out and buying more homes, well, home prices would go up, because now you'd see more bidding wars again. Likewise, if people start buying more cars, well, that means car prices would likely start going up again too. That makes inflation worse, but that could also boost the economy. Now, you can boost the economy, which is great in the short term, but remember, inflation hurts some people more than others. Inflation hurts the average person more than the financially educated. And if you still don't believe me, take a look at this chart. This is a chart showing the net worth of the top 0.1% financially in blue and inflation in red. I mean, it's not directly inflation, it's showing the money supply, M2 supply. But what you'll see is that as the supply of money goes up, the wealthy become wealthier. Why? Because they know how to capitalize on inflation. See, what you gotta remember is that inflation isn't the prices of things rising. That's a byproduct of inflation. Inflation is when you inflate the money supply. It's when you increase the amount of dollars out there. When you increase the amount of dollars out there, that decreases the value of each individual dollar. It makes the buying power of each dollar go down, which then causes the price of things to go up. So who does inflation hurt? Well, it hurts all people. It hurts consumers, and every person is a consumer. Rich people are consumers, middle class people are consumers, poor people are consumers. When you go out to eat at Chipotle, you're a consumer, and that costs you more money. And so now when you go out to eat at Chipotle and it costs you more money, that hurts you because you got to pay more money out of your pocket. It doesn't matter if you're rich, middle class, or poor, that means you got to pay more money. But that also benefits some people, the financially educated more than others. I'm going to stick with this Chipotle example because if you own stock in the Chipotle company, if you're financially educated and you invest in stocks or assets, inflation also means more dollars are flowing into your asset. Inflation means the company that you own is getting more dollars. Now, I'm not saying you should go out and invest in Chipotle. It's just an example. But what you have to understand here is when you have inflation happen, it benefits some people more than others. It benefits the asset owners. Another example of this is take a look at the housing market. When we saw this huge run up in housing prices between 2021 and now, who did that benefit? Well, it benefits the home sellers and the home owners. If you bought a home in 2019 and you're still living in that home, the home is worth a lot more money today on paper. Now, of course, you don't actually realize that money unless you sell the home or unless you pull cash out of the home, which don't pull cash out of your home to just go out and finance a boat. That is not a good thing to do. But you don't actually realize the value of this new equity unless you sell your property. However, this is where what I want you to understand is that inflation benefits some people while hurting others. And if you want to win in this game, you have to understand how this economic system works. But before I get into how you take advantage of that, let me go over number 3, which is the White House. Now, again, my goal is not to get into the political side of things. I just want you to understand how our system works and why you need to make sure you're doing your own due diligence and taking things with a grain of salt. I don't care if you're Democrat, Republican, or somewhere in the middle. You got to take things with a grain of salt. Take a look. According to the White House, the United States economy is, quote, firing on all cylinders and inflation is on a path towards a more normal level. So after we got this economic report saying that our economy grew significantly slower than expected, the White House naturally wanted to say something. So the Treasury Secretary Janet Yellen came out and said that number 1, our economy is firing on all cylinders and is stronger than what the data suggests. And then she said number 2, the good news also is that inflation is on a downward trajectory, even though for the last 3 months, what we've seen is that inflation has come out hotter than expected and gone up month over month over month over the last few months. And this is why I say you want to always take things with a grain of salt, because it doesn't matter who's in the White House. They never want to make it look like they're the bad person. Now, of course, there are other factors involved besides just the president, but you want to make sure that you are doing your own due diligence and not just blindly listening to a random guy on YouTube. You're not just blindly listening to a random article on the internet, and you're not just blindly listening to the White House. It doesn't matter who's in office. In fact, let me dig a little bit deeper and show you why the White House said these 2 things. Take a look. First, when it comes to the economy, the weaker reading on the economic report was not, quote, concerning. And number 2, the Treasury Secretary believes that the fundamentals here are in line with inflation continuing down back towards normal levels. I mean, we all remember back in 2021 when we were told that inflation was transitory. And then finally in 2024, the White House came out and said that they regretted calling inflation transitory. And so this is where, again, make sure you take things with a grain of salt, which brings me to number 4. How do you find the opportunity? There's a saying on Wall Street that goes, bulls make money, bears make money, but pigs get slaughtered. And what that means is bulls, people who think the market is going to go up, make money. And bears, people who think the markets are going to go down, make money. But pigs, people who get greedy, those are the ones that get slaughtered. Those are the ones that lose money, which means you really just need to have a understanding of how our economic system works. That way you can win whether the market is up or down. And what I mean by that is you have to understand our economy moves through cycles. There are times where our economy goes up and there are times where our economy goes down. This is a fact. Our economy has gone through booms and busts every decade for the last century. Our markets have gone up and down always. Now, over the long term, if we take a look at the stock market over the last 100 years, we'll see that the stock market has gone up over the long term, but it's not linear. There are times where the market goes up and down. And the reason why so many people end up losing money is because, number 1, they have no idea what to invest in. People go out and try to find the next hot stock. They try to find the next Amazon. They try to find the next Nvidia. They try to find the next hot stock. And then they just throw their money into a random meme stock, into a random stock that they read on Wall Street Bets, into a random stock that they see on Reddit. And then they hope that the stock is going to double in 6 months. So that's where, number 1, stop trying to play the get-rich-quick game. If you want to actually be an investor, you have to actually be an investor, and that means invest your money into a strong asset that you want to own for the long term. And by long term, I don't mean 6 months, I mean years. That way you can let your money compound and grow. Number 2 is if you're not going to put in the work to actually analyze an investment, if you're not going to put in the actual effort to research your investment and to keep up with your investment, then don't invest in individual companies. Look for opportunities to get some diversification. For example, you can look at things like index funds, mutual funds, ETFs as a way for you to get some diversification and as a way for you to now protect some of your assets because now you get, well, more investments. Because when you invest in a fund like an ETF, you can invest in one ticker symbol that will give you exposure to dozens or hundreds or even thousands of companies. This way now you're not relying on one company to make money in order for your investment to be profitable. And this is where now you got to understand what you want to do. And number 3 is understand how to invest. Because some people are trying to time the market. They're trying to time the market when it comes to selling and when it comes to buying. And the reason why this is so difficult is because we always get into this mindset of, oh, I think I can make a little bit more money. I'm going to wait just a little bit longer. And what ends up happening to a lot of people is you miss the opportunity. And this is where you want to understand what is your real strategy to invest money, to make money. I'll give you an example of this. When the 2020 pandemic happened, when I was talking about how the markets are going down and I was buying in phases on the way down, some people said, you've lost your mind, why would you buy stocks during this market crash? But other people were saying, Jaspreet, don't buy yet. Wait for the market to fall further. Wait for the market to fall further. Wait for the market to fall further. And my response is always, I have no idea how far down the market is going to go. So instead, I will buy in phases on the way down. And as the market goes down even lower, I'll buy even more aggressively. Because you can't time the bottom. Then the market started to go up and people were saying, well, I'm not going to buy now. I'm going to wait until we see a bigger dip because I missed the opportunity. And then we saw the stock market rise at the fastest rate we've ever seen in American history. So people that were trying to time the market missed out on the opportunity to buy at a huge discount. And this is where now what you want to do is understand what is your strategy. For me, I have two strategies. I'm very straightforward with this, and I can't tell you what to do. I don't recommend what I do to anybody else. I just tell you what I do just as a way to inform you of where I'm coming from. I have two strategies. Number one is I have a system where every Wednesday, money is pulled out of my checking account and is automatically invested into my portfolio of ETFs. This happens every Wednesday, whether the market is up or whether the market's down. It does not matter. I don't care if the market's crashing. I don't care if the market's booming. I don't care if it's raining outside. I don't care if it's snowing. This continues to happen no matter what. And the bulk of my portfolio are dividend-paying ETFs because I want cash flow. So this happens every Wednesday, no matter what. I don't care if the market's crashing or not. This continues to happen. Then, on the flip side, I have a separate pile of cash that I work to grow. That way, if I see a good opportunity, if I see a stock fall that I like the company of, or if I see the markets crash, well, now I have this pile of cash that I can go and dump into the markets at a more aggressive rate because I see this opportunity and I'm prepared for that. You have to understand what is the right strategy for you. For me, this gives me an opportunity to win when the markets are down and up, because if the markets are going up, well, now my investments are going up and that's good. And if markets are going down, I can still win because that gives me an opportunity to go out and dump some more cash into the markets and buy more investments at a discounted price. And this is where what you want to understand. Again, and I say this because I don't want people to be blindsided if something bad were to happen, because the reality is our economy goes up and down. And you want to be prepared for the ups and down. Most people assume that whatever is happening in the market today is going to continue happening forever. That when things are bad, it's going to stay bad forever. When things are good, they're going to stay good forever. But that's not how it works. Markets go like this. They go up and down. And most people have a very short-term memory. And this is where my goal is just to remind you that you want to make sure you can prepare yourself, meaning invest in your financial education. Yes, that means time, and maybe that means money, depending on what you want to do. Time in the sense of learning. Watch videos. Read books, maybe take classes, maybe hire a coach, depending on what your goal is. But invest some time and maybe money into your education. That way you can learn to be a better investor. That way you can learn how to analyze your investments, depending on what it is you want to do. And then also work to be prepared. That means don't spend all of your money. Have some extra cash to put aside to protect you, and cash to be able to capitalize on investments. The reason why so many people get screwed over anytime you have a recession is most people are living hand to mouth. Because anytime they make money, they spend all that money. Now you might say, but Jaspreet, it's hard. How do you expect me to do that? I get it. But the reality is either you can put in the sacrifice, put in the hard to protect you, or you're going to have to deal with the hard when things really go wrong. And this is where I'd rather you choose that hard, choose that sacrifice, because that way when things do go hard, you'll be protected. And you won't be as struggling as everybody else when things do go wrong, because things will go wrong. When? I don't know, but we know that things always go wrong. It's happened every decade for the last century, so be prepared that we can capitalize on opportunities instead of being one of the people that get panicky and that freak out and that panic sell because you weren't prepared for what we've seen happen decade after decade after decade after decade after decade. So when it comes to finding the opportunity, that means number one, be prepared by having the cash put aside, and number two, invest in your financial education. That way you know how to find the good opportunities. So if you look at the inflation chart, you'll see that inflation peaked at 9.1%, while wage growth only peaked at 6.7%. But if you go back to the inflation chart, you'll see that inflation is rising now versus wage growth is falling now. The wages are falling while inflation has been rising. And that's not a very good trend to have happen at the same time.